All right, folks, let's talk about something that might sound boring but actually affects your life more than you think. Federal Reserve rate cuts. The Federal Reserve, or the Fed as the cool kids call it, controls the federal funds rate. This rate is like the thermostat for the entire US economy. When they turn it up, money gets more expensive to borrow. When they turn it down, it's like a sale at the money store. Citi, one of those big banks, is predicting that the Fed might cut this rate by a whopping 200 points. These rate cuts could affect everything from your credit card bills to your mortgage payments. So, if you've been thinking about taking out a loan or refinancing your house, you might want to pay attention to this financial soap opera. Now let's dive into why Citi is making this bold prediction. They're looking at some pretty worrying signs in the economy. First off, they're seeing a slowdown in economic growth. Less spending, fewer jobs being created, and businesses being more cautious about investing. Then there's inflation. Citi thinks that party might be coming to an end. They're predicting that inflation will cool down faster than a hot potato in a freezer. Citi thinks the job market might start to wobble, with signs that hiring might slow down and unemployment could tick up. If there's one thing that makes the Fed nervous, it's the idea of people losing their jobs. So why is the economy slowing down in the first place? It's a question on everyone's mind these days. Well, it's not because everyone suddenly decided to take a collective nap. The reasons are far more complex and multifaceted. First up, we've got the hangover from all those previous interest rate hikes. These hikes were meant to control inflation, but have had some unintended consequences. The Fed had been raising rates faster than a teenager's excuse for missing curfew. It was a rapid-fire approach to a persistent problem. They were trying to cool down inflation, but now it looks like they might have overdone it a bit. The economy is feeling the strain, and businesses are starting to feel the pinch. Then there's the global economic picture, which is about as pretty as a Jackson Pollock painting made with mud. It's a chaotic mix of factors that are hard to untangle. Trade tensions, geopolitical uncertainties, and enough economic drama to fill a season of keeping up with the Kardashians. These issues are creating a lot of uncertainty and instability. Consumer spending, which is usually the engine that keeps the economy chugging along, is starting to sputter. People are tightening their belts and cutting back on non-essential purchases. People are getting a bit more cautious with their wallets, probably because they're worried about job security, or they're still recovering from the sticker shock of inflation. The fear of the unknown is making everyone a bit more frugal. And let's not forget about the housing market. It's another critical piece of the economic puzzle that's facing significant challenges. Higher mortgage rates have made buying a house about as affordable as a private island. This has put homeownership out of reach for many, further dampening economic activity. So there you have it. A mix of high interest rates, global uncertainties, cautious consumers, and a struggling housing market. It's a complex web of issues that will require thoughtful solutions and careful navigation to overcome. Now let's talk about how these potential rate cuts could affect you, dear viewer. First off, if you've got a credit card balance, you might see some relief. When the Fed cuts rates, credit card interest rates tend to follow suit. For those of you with mortgages, especially adjustable rate mortgages, this could be like finding money in your coat pocket. Lower rates could mean lower monthly payments. And if you've been thinking about buying a home, this might be your moment. On the flip side, if you're a saver, you might want to brace yourself. Those high-yield savings accounts that have been all the rage, they might not be so high-yield anymore. And for all you want to be Wolf of Wall Street types out there, the stock market could get interesting. What different experts are saying. Now, as with anything in economics, there's about as much agreement on this topic as there is on pineapple on pizza. On one side, we've got the optimists. They're saying 200 basis points? That's nothing. The Fed might go even further. Then we've got the skeptics. They're saying Citi's prediction is about as likely as me winning an Oscar for my economic commentary. They argue that the Fed won't want to cut rates so aggressively for fear of reigniting inflation. In the middle, we've got the cautious observers. They acknowledge that rate cuts are likely, but they're not willing to put a number on it. The Fed's balancing act, inflation versus growth. Now let's talk about the tightrope act the Fed is trying to pull off here. On one hand, the Fed wants to stimulate the economy and keep the job market strong. They want to cut rates to make borrowing cheaper, encourage spending and investment, and keep the economic party going. But on the other hand, they're still traumatized by the inflation scare we just went through. If they cut rates too much too fast, they risk reigniting inflation. So the Fed has to thread this needle carefully. They need to cut rates enough to give the economy a boost, but not so much that inflation comes roaring back. And let's not forget, the Fed isn't operating in a vacuum. They've got to consider global economic conditions, political pressures, and market expectations. Global ripple effects of U.S. rate cuts. All right, folks, let's zoom out for a moment and look at the bigger picture. The decisions made by the U.S. Federal Reserve have far-reaching consequences that extend well beyond American borders. Because when the U.S. Fed makes a move, it's not just Americans who feel it. The entire global economy can be affected, influencing everything from trade to investment flows. First off, let's talk about the dollar. The U.S. dollar is the world's primary reserve currency, and its value can impact global trade and finance. When the Fed cuts rates, it typically weakens the dollar. This depreciation can have a variety of effects on international markets. A weaker dollar can actually be good for U.S. companies that sell stuff overseas. It makes their products more competitively priced in foreign markets. It makes American goods cheaper for foreign buyers, potentially boosting U.S. exports and helping to balance trade deficits. But here's where it gets interesting. The ripple effects don't stop there. When the U.S. cuts rates, other countries often feel pressure to follow suit. Central banks around the world may lower their own rates to keep their currencies from appreciating too much against the dollar. Countries that don't cut their rates might see their currencies strengthen against the dollar, which could hurt their exports. A stronger currency makes their goods more expensive on the global market. For emerging markets, U.S. rate cuts can be a double-edged sword. These economies often rely on foreign investment and trade. On one hand, lower U.S. rates can make investors more willing to put money into riskier assets in developing countries. This can lead to increased capital inflows and economic growth. But on the flip side, if these countries have borrowed heavily in dollars, a weaker greenback could make their debt more expensive to repay. This can strain their financial systems and lead to economic instability. And let's not forget about the impact on global financial markets. Stock markets around the world can react strongly to U.S. rate cuts, with investors adjusting their portfolios based on new economic expectations. When the U.S. cuts rates, it can send ripples through stock markets around the world. These movements can affect everything from individual retirement accounts to large institutional investments, highlighting the interconnected nature of our global economy. Looking ahead, what this means for you. So, after all this economic mumbo-jumbo, what does this actually mean for you, the average person just trying to make ends meet? Let's break it down in simpler terms. If these rate cuts do happen, it could mean a few things that might directly impact your daily life and financial decisions. First, if you're thinking about borrowing money, whether it's for a house, a car, or to start that artisanal pickle business you've been dreaming about, it might get cheaper to do so. Lower interest rates generally mean lower borrowing costs. For homeowners, this could be your chance to refinance. Refinancing at a lower rate can save you a significant amount of money over time. If you've been stuck with a high interest rate, these cuts could be your ticket to a lower monthly payment. Imagine the relief of having extra cash each month. If you're in the job market or worried about your current job, these rate cuts are the Fed's way of trying to keep the employment party going. Lower rates can stimulate business investments, potentially leading to more job opportunities. But here's the kicker. All of this is still speculation. Nothing is set in stone yet. The Fed hasn't actually done anything yet. They're still in the decision-making process, weighing the pros and cons. So while it's good to be informed, don't make any drastic financial decisions based solely on these predictions. Stay updated, but also stay cautious and consult with a financial advisor if needed.